Good afternoon, everyone. Welcome to our Asia Pacific REIT strategy session. I'm Isis Ma, the Client Portfolio Manager for Equities based in Hong Kong. Today, it's our pleasure to invite our investment specialist for Asia Pacific REIT strategy, Hui Ming Ng, who is based in Singapore, to join us to share her insights about the AP REIT strategy. So, Hui Ming, looking back in 2020, was an unprecedented and challenging year for REIT across Asia. So actually, what drove the drawdown in March last year? And do you think that actually the COVID impact, the initial COVID impact, is now behind us?
Hi, good afternoon, everyone. Thanks for taking time to join myself and Isis this afternoon on this session on Asia REITs. Last year was indeed a very challenging year for global economies as well as for all financial markets. If you recall, in the middle of March 2020, the coronavirus outbreak was officially declared a global pandemic by the World Health Organization, and this sent Asia REITs sharply lower on panic selling. At the peak of the pandemic last year, we've seen that almost half the world's population were asked or ordered to stay at home by their governments to prevent the spread of the deadly virus. Against that backdrop, with people being emptied out of buildings like retail malls and offices, there were increasing uncertainty and doubts over whether landlords would be able to collect their rents and to pass on these cash flows to investors as dividends. With uncertainty on both the duration of the pandemic as well as the impact, some of the Asia REITs started to withdraw their dividends guidance, and some decided to keep a higher level of cash levels to cut their dividend payout ratio to conserve cash. At the worst, we have seen market pricing in as much as 40% decline in asset values for Asia REITs in some of the REITs, and we think this was being over-excessive and over-bearish. Throughout the last year, we grew to understand that the impact from the global lockdowns were very different across the real estate space. Certain sectors like retail was naturally more badly affected because tenants are closed and people are not visiting malls and are not consuming anything. Hospitality REITs were also among the worst affected as borders remain closed and there's no domestic tourism or even international tourists. However, on the other spectrum, we have seen office and industrial specialized REITs holding up very well, enjoying very high rental collection rates and very low rental default rates, even through the worst of the pandemic. Throughout the whole of last year, we have seen the local governments in Hong Kong, Australia, and Singapore rolling out very aggressive stimulus package amounting to as much as 20% of GDP to help save the economies. This has helped to cushion the economic drag from the lockdowns and help in the rebound in the respective economies as these countries exited their respective lockdowns throughout the second half of last year. Sentiment for Asia REITs further improved towards the end of last year as there were more positive data points on successful vaccination rollouts to be rolled out in all the major economies from 2021. We believe, Asia REITs are now in a better place with economic recovery on track. While we are expected to see some speed bumps on some new waves of infection coming from variants of concern, the most parts of the global economy will still remain largely functional as measures are now more targeted. The defense capabilities that were built over the past year have enabled Singapore to say that we no longer need a circuit breaker to contain any new waves of infection, allowing Singaporeans to enjoy more normality in their lives and to improve further in opening up towards the end of the year. The healthy vaccination rollouts across the region continues to be very positive for read-through in cash flows as well as dividend recoveries for Asia REITs.
Thanks, Hui Ming, for the very detailed recap. Indeed, the 40% drawdown last year was very remarkable. And imagine if investor left the market at that time, they will actually miss the rebound opportunity that active manager positioned to capture. So as you mentioned, now the worst seems to be behind us and the vaccine rollout in the region and globally. So the fundamentals for REITs remains pretty solid, I believe. So what's your view on that?
Yes, for this year, 1 year later post the pandemic breakout, we believe Asia REITs are on track for cash flows as well as rental collection recoveries. And key markets like Australia, Singapore, and Hong Kong are expected to see very high vaccination rates for their population by the end of this year. Industrial REITs, which were highlighted, have been very resilient throughout 2020, and we believe it continues to enjoy very high predictability of income even throughout this year. There are two key reasons for this. The first is the structural trends of e-commerce and online sales remain very strong, and it was expedited with the COVID situation as more people are buying online. The second trend is that in the post-pandemic environment, we have seen landlords telling us that their traditional tenants from normal retailers, the traditional retailers, the companies, the manufacturing companies, are also adopting a higher warehousing requirements and space requirements because, as we have seen last year, a lot of companies were hit by supply chain bottlenecks and disruptions. As a result of that, some of them are changing from just-in-time inventory kind of model to just-in-case inventory, thereby generating more warehousing requirements. Now, on the other hand, retail REITs, which were hurt by very high rental release and commissions that have to be given in 2020, will enjoy very strong earnings rebound this year, as COVID situations remain very well managed and they are no longer required to give very generous rental rebates to their tenants. Throughout this pandemic, we have seen how low rates continue the global search for yield, and REITs continue to deliver positive dividends returns for their investors. With these attractive yields as well as a spread between the cost of borrowings as well as the net property income yield on real estate, we are optimistic that capital values for Asian REITs will hold up better than what the market has initially feared at the worst of last year.
So, right. So, yeah, actually, you've touched on a very good point that actually for many investors, when it comes to investing in REITs, like dividend of REIT is still a very important source of income. And as you mentioned, dividend return is still a key feature for AP REITs. So, AP REITs overall is still a very interesting asset class and worth to get exposure to. And if we come to actively managed REIT strategies like ours, so I mean, our audience asks, what do you think of why active management matters for investing in REITs instead of they pick their individual REITs or buy a passive ETF?
Okay, if you take a step back and look at just the Singapore REITs universe performance in 2020, we can see that in a pandemic year, there was a wide dispersion of returns even within the Singapore REITs. And this is not the case only in 2020, but also has been seen in the past 3 years, 5 years performance of the universe as well. The way we look at REITs is very important, is to focus on sustainable and quality income and total returns perspective of each REIT, and not just the headline yield of how much this REIT gives me in terms of dividends on a single year basis. Having in-depth knowledge and analysis of each REIT is important to avoid any pitfalls of investing. At Manulife, we are focused on fundamental bottom-up approach and overlay with top-down considerations for our REIT investments. We consider a basket of both qualitative and quantitative factors to assess the investment merits of each REIT. REITs are essentially real estate investments, and typically real estate demand and supply outlook generally has very big implications on how rental rates will grow and how occupancy rates will hold up. This has a very big read-through on the ability of a REIT to grow their top line. It is also important to study the underlying lease term, how the landlord structure the leases, how diversified is the tenants base, how credit-worthy is the tenants to withstand economic cycles, to ensure predictability and sustainability of a REIT income stream over time. A strong parentage has also good deals as well as a pipeline of assets that will enable a REIT to grow its scale or to grow its dividends over time. Capital management strength is also very important, as REITs typically gear up to acquire new assets. On the quantitative side, we assess the merits and the valuation of the REITs based on how it's trading relative to its asset value, how we see asset values going over time. For example, we have always liked the fund managers, the REIT fund managers in Australia REIT space. given their very strong track record and their ability to partner with global players and capital partners to grow their asset under management. With a low interest rate environment, these fund managers continue to be able to beat expectations on their ability to grow their fund or asset under management and ability to grow their fund and property management fees. Secondly, despite borders being closed, this REIT has a master tenant, which is also its sponsor, and this sponsor has strong creditworthiness. So even though there were no tourists to Singapore, the master tenant has continued to honor its rent obligations, and the REIT was able to pass on all this rent to investors as dividends.
With all the views that you have shared, like what are the opportunities you see, like for example in Singapore, Australia, or Hong Kong? And are there any new markets that you think that AP REITs will be interesting to look at?
If you compare the regions since the pandemic until today, we have seen that Australia REITs has actually recovered very strongly from the COVID lows, given their well-contained COVID situation, as well as very strong GDP rebound for the Australian economy. Singapore market generally has lagged behind the peers like Hong Kong and Australia, because sadly, maybe because of the recent heightened measures again. And valuations in Singapore definitely do look relatively more attractive if I see it on yield spreads basis right now. On the subsectors level, we continue to like the industrial REITs, but we are also selective and we like some of the pre-opening plays across the region. As a case in point, we like the very well-diversified logistic company with a strong sponsor. The sponsor is one of the big developers listed on the Singapore Stock Exchange. We have earlier identified very strong warehousing demand in Australia, and this REIT does own a portfolio of quality logistic, young and high specification logistic assets, and with very strong leases, long defensive leases, and these leases come with actually annual rental step-ups. Its tenant base is very well diversified, and it enjoys close to 80% of its portfolio is exposed to tenants in government-linked companies, core and resilient industries, as well as the new economy sectors. With help from the sponsor, this REIT has been able to grow in scale and in terms of dividends, and has executed very well on buying more freehold quality logistic assets across Europe and Australia to grow its footprint. On valuation-wise, it was trading at discount to selected industrial peers in the region, which we believe was unwarranted. Apart from the industrial space, we are also moving more into pre-opening plays since the end of last year through investment in a bit more of the diversified REITs. We believe any sell-off in terms of market because of any renewed concerns are buying opportunities for the reopening beneficiaries.
So in terms of yield that investors are really focusing on, what sector offer a higher predictability and why?
Definitely industrial REITs, in terms of the predictability of the incomes, still remains very strong. Firstly, all the manufacturing companies and all these are back in business fully. They are not affected by any renewed lockdowns or circuit breaker kind of scenario. Their underlying leases are longer. They have strong structural demand for the warehousing requirements for their assets. And in early part of this year, we have seen that these industrial REITs have also come back very strongly on the M&A front. In the first 5 months of this year, we have seen over 3 billion worth of acquisitions done by industrial REITs in Singapore. And in Australia case, in the private markets, we have seen very strong transactions done in logistics and warehousing assets as well.
Right, understand. Thanks, Hui Min. So, well, we know that, as you explained, that REITs actually does not perform homogeneously, and the return dispersion can be very wide. So you touch on some outlook, but we have questions more on the outlook. Can you give us the current outlook for Asia REITs in general?
We believe the structural trends are there, demand is there, and we still believe there will be healthy capital values kind of gains as cap rate compression remains a strong theme for industrial assets. The inorganic growth driver has also come back on as economies exit their lockdowns, and we have seen industrial REITs being active to buy assets that drive their DPU growth. On retail malls, we are very selective. Contrary to some of the views out there, we don't think retail malls are dead despite e-commerce. We have seen how consumer traffic as well as tenant sales can rebound once social distancing measures are relaxed. We have seen how the Hong Kong retail REITs are saying how demand has come back after they managed to contain their latest wave of infection. And in Hong Kong case, the government is still rolling out cash vouchers given to all their citizens aged 18 and above to spend on retail. And it's about Hong Kong dollars, $5,000 per person, which is very generous. So within the retail space, we are very focused and selective. We pick REITs that own malls that are very resilient and are actually have very strong catchment and are popular in their locality. And on office, we are actually more sanguine on the outlook. We think an inflection point might be near for central office in Australia and in Singapore. Given that supply is actually very contained in Singapore, there's even withdrawal of office stock. And we have seen that the new buildings that is due to complete in Singapore has actually achieved very high pre-commitment rates, likely to be above 80%. And there are no new builds, and new supply has been pushed out further to 2023 to 2024 because of the construction delays. And there has been some demand from tech companies, life sciences companies, that help to compensate for the space that are given up by the traditional office users like the banks. So we are actually not so bearish on office, and it is a kind of pre-opening sector that we like to participate in as well.
And you mentioned about predictability of income for industrial sectors is more certain. Can we expect the predictability to recover, and what's your rationale behind that?
Definitely, we believe that the predictability of income will definitely improve this year. We have to take in context that last year there was so much uncertainty because nobody knows how long lockdowns will last. And there was also new COVID laws introduced in countries like Singapore and Australia, where the government actually mandated landlords to give rental holidays. Now, currently, we are actually in a much better situation 1 year on. There's rising confidence on consumer and corporate part. Economy is improving. COVID situation remains well controlled. And we have seen the Singapore REITs since the early of this year, they have started to pay out the income they retained last year, and also restore full distribution of dividends payout. And for the Australia REITs case, most of the REITs have restored their dividends guidance. And actually, for some of the Australian REITs, they even upgraded their earnings and cash flow forecast over the last 6 months.
So should investors worry about the near-term impact of inflation? And what's your view on that?
We believe a healthy level of inflation that is driven by sustainable kind of economic growth is a positive. REITs are generally proxies to real estate, and real estate leases are inflation hedges and may benefit from the continued asset reflation theme. This year, we also expect Asia REITs earnings and cash flows to grow given the low base last year, and this should help compensate for higher bond yields as well. If you talk on the cost level, interest cost increase will not be a big detrimental impact on cash flows, given that the REITs generally have very comfortable gearing levels. They have very staggered debt maturity profile, and a high percentage of their borrowings are actually locked in fixed rate basis. Some of the REIT lease structures are also CPI linked or annual step-ups that can offset any inflationary cost pressures. And generally, for some sector like office REITs, they have shown to be more sensitive to employment growth as well, because economic growth outlook actually has a high correlation with how office rental rates go.
So thank you very much, Hui Min, today, and then we look forward to see you in our next catch-up session.
Thank you, everyone.